Good morning, ladies and gentlemen. I've been asked to come and talk to you about captives and what they are, all right? The people here at the front and on certain of the tables know what these things are, but the journalists in particular don't. And as I think you're aware, in August of this year, we're holding a regional captive conference here in Malaysia, and we want you to cover it. And we thought that it would be helpful if, in anticipation of that, we gave you a better feel for what these things are, why people have captives, what they do, stuff like that, okay? But we are in danger of covering a lot of ground in a very short period of time. This is like talking in mathematical terms about differentiation and integration, all right? When people only know how to add and subtract, all right? Now, some of you are commercial journalists, so you will have a greater knowledge of things like commercial insurance than others. But Nasri's already touched on something that you might not have even heard of, something called reinsurance. And if you've never heard of reinsurance, then captives are, once again, quite a long way down the path, all right? I suppose the big message, though, about Labuan is, as Daniel was saying earlier, it's a wholesale specialist market. It's not for day-to-day Malaysian insurance. It's for wholesale specialist insurance and reinsurance. So by definition, we're going to talk in some jargon, and we're going to use some technical terms. There is going to be a panel session afterwards, so if you've got questions, please ask them then. But if something's not clear as we're going through, please just stick your hand up and ask that question, because it may be then that the rest of the story is completely unintelligible. We're going to talk about why corporates self-insure. And I want to, before I even start talking about that, I want to differentiate between self-insurance and non-insurance. Okay? You have cars, you have houses, you have other assets. You can, well, subject to the law, which requires you to buy certain insurances, like on your car, but apart from that, you can just not insure your assets and your liabilities. In your daily lives, you can just go about your daily lives and not buy any insurance, okay? That's a sort of a non-act. That's not self-insurance, that's non-insurance, okay? The act of self-insurance is where a person or an organization or a corporation decides to manage its risks through a process called self-insurance. So that's a key thing to understand, all right? Let's start talking about what a captive insurance company is, but even before then, let's just reiterate what Nasri said earlier. You buy insurance onshore Malaysia with insurance companies here in Malaysia. Some of it you're required to do, some of it you choose to do. But insurance companies themselves also buy insurance. They lay off some of the risk. Typically catastrophe risk, floods in Malaysia, all right? Tsunamis, terrible disasters in Malaysia and in other countries, they happen. So insurance companies lay off some of that catastrophe risk and other risk to third-party specialist reinsurers, okay? And then reinsurers, and you'll see this later, reinsurers themselves lay off some of the risk sometimes to what we call retrocessionaires, all right? So there's this whole chain of risk carriers, and in addition to those risk carriers, insurers, reinsurers, retrocessionaires, there's also intermediaries that facilitate, negotiate those contracts between the parties, okay? They're called brokers. We were talking about them earlier, insurance brokers and reinsurance brokers. So you have to understand sort of all of those entities are what make up what Nasri was talking about in Labuan, called an ecosystem, all right? So that's the picture I'm trying to paint here. Now, captive insurance companies are when corporates or bodies or associations decide to self-insure. not non-insure, not fail to buy, but decide they're going to self-insure through a wholly owned entity called a captive. They establish a subsidiary company that's licensed in a certain jurisdiction to write insurance and reinsurance. Perhaps there's one thing we haven't covered so far, but just bear in mind that, like most financial services, insurance and reinsurance, onshore and offshore, is a highly regulated activity, all right? So in order to be an insurer in Malaysia, in order to be a reinsurer in Labuan, you have to have certain licenses from the appropriate regulator. Bank Negara onshore, Labuan FSA offshore. So just bear all of these things in mind. I don't think you're going to understand all of this today, but let's just try and get the key messages across, all right? So a captive insurance company is a wholly owned insurance company. So a company like Petronas a few years ago, many years ago now, decided that it wanted to manage its own risks better, more efficiently, through the establishment of a subsidiary that it established to insure its own risks. Okay, and that's essentially what a captive is. Insures the assets, the liabilities, and other risks of its parent. All right? Now, that's the key thing. That's the definition. It's a very loose definition. I'll have a very formal definition for you in a second. But the second thing you need to know is that we typically establish or domicile these captives in jurisdictions that are where tax, solvency, and reporting requirements are relatively less onerous. I mean, there are many reasons why you would do that, but essentially it's your own company, it's your own insurance company. You're not, for the most part, insuring third parties. You don't need all of the red tape and regulatory burden that a traditional insurance company onshore Malaysia or onshore any territory needs. So you would put it offshore into a jurisdiction where tax, solvency, and reporting, regulatory reporting, is relatively limited. Okay? As we also mentioned, these entities called managers. Now, Labuan, like offshore jurisdictions everywhere in the world, has its managers. And these are specialist companies. Etika Offshore is one of those, but there are a number of others in Labuan, that their whole raison d'etre, what they do, is manage insurance and reinsurance activities on behalf of companies that are domiciled there, but owned by parent companies elsewhere. That can be captives, but it can also be local subsidiaries of reinsurers or brokers, these other people we were talking about earlier. So we've got these managers, okay? They act as accountants and administrators of the captives, okay? But just remember, because we're talking about the assumption of risk, this is a fundamental activity. There is the potential for significant loss in the event that certain things happen. You as the owner, the parent of this captive sitting in Labuan or wherever, you want to make sure that you make the key decisions. So the parent company takes the key decisions about how much risk is retained by that subsidiary, by that captive, and how much is reinsured. Because like I was talking about earlier, insurance companies buy reinsurance. Captive insurance companies also buy reinsurance. Okay? Just to be clear. Just some statistics, 75% of the Fortune 500 companies have captive insurance companies, some more than one in certain jurisdictions. Okay? And it is estimated that about $14 billion of premium across some 5,000, 6,000 captives worldwide. So this is not an insignificant industry. The captive industry is a large global industry where domiciles manage and organize the captive industry. Okay. Now, this is a more formal definition. This is from something called the International Association of Insurance Supervisors, of which Labuan FSA is a member. This is a club of all the regulators of insurance around the world. And this is their definition from October 2016 of what a captive is. So it's either a insurance or a reinsurance entity, can be both, owned directly or indirectly by an industrial, commercial, or financial entity, the purpose of which is to provide insurance or reinsurance cover for the risks of the entity or entities to which it belongs, and for entities connected to those entities. And only a small part of any risk exposure is related to insurance or reinsurance of other parties. Now, some captives, just so you know this, don't just write the insurance or the reinsurance of their parents, their owner. They can write reinsurance of third-party risk. Okay? Not something I'm a great advocate of, and I think some people share that view in this room. Some captives have got into an awful lot of trouble writing what we call third-party business. But fundamentally, they are allowed to by certain regulators, so you need to be aware of that. But fundamentally, their core business is to underwrite the risks of their parent. Different types of captives. The pure captive is the one I've been focused on so far, but you can also establish, or captives have been established and exist and look after the risks of various groups, associations. There are also what we call rental captives and protected cell captives. Labuan has a special category of license for protected cell captives. I think that's probably too far advanced for today's discussion, but just be aware that Labuan has all of the different facilities, the different licenses, as do the other jurisdictions around the world. Okay? Why would you form a captive? I mean, in one sense, just think about it for a second. When you, as a company or as an entity, pay away premium, why do you do that? Why do you buy insurance? You do it so that if certain things happen, you can claim under the insurance or the reinsurance policy, yes? A terrible disaster, a terrible fire, you incur a liability to third parties. You pay away the premium so that in certain circumstances, you get usually significantly more money back in form of a claim than you paid in terms of the premium, yeah? All right. So then just think about it. Let's not use the Petronas example. Let's use Genting. Also has a captive, okay, in Labuan. Why would Genting take premium from one pocket and put it into the other pocket? And when it has claims, take money from one pocket and put it back into the other pocket. If you think about it from an accounting perspective, upon consolidation, it's a zero-sum game. You know, premium from the holding company to a subsidiary, and claims as and when they occur from the subsidiary to the parent. When you add up all the sums at the end of the year, there's no real benefit, yes? All right, so just, you need to understand that as a starting point before you then say, well then why are people doing this? Why does 75% of the Fortune 500 companies do this? Why do people spend $14 billion of premium a year? Okay. The reason is one of these, or a whole series of these, okay? Firstly, the one thing that happens in organizations when instead of paying premium out of the organization to a third party, when they pay it to a subsidiary, everyone from the finance function and downwards suddenly gets far more sensitive to risk, okay? Because if we have a claim, we're paying some of that claim ourselves, okay? So we need to be much better at how we manage our risks. So we believe, and I think history has shown, that it has really helped organizations culturally, organizationally, focus on risk management, okay? And that's a core capability, I think, for successful organizations in today's world, okay? One of the other reasons for establishing a captive is if ultimately, as an organization, most of your risk ends up in the reinsurance world. And that's what happens with some of the specialist classes of insurance like energy, like aviation, like marine. There isn't often in countries like Malaysia, to be frank, a lot of domestic capacity for some of these very specialist risks, but where the assets and liabilities involved in those activities are huge. Billions of dollars of assets and liabilities in aviation, in marine and energy, but a relatively small capacity here domestically. So ultimately, that risk has to go to the global reinsurance market, okay? Now, if you have a captive, you can go and negotiate directly with those reinsurers in Switzerland, in Bermuda, okay? You don't have to rely upon, with all due respect, Nasri, Etika Insurance to do that negotiation for you. Because if you know that ultimately most of your premium is going to go to Switzerland or to Germany or to Bermuda, why don't you go and talk to the horse's mouth and negotiate the best possible terms? So that's often touted, and I think it is true, as one of the key reasons why organizations would have a captive. Cash flow. You know, at the end of the day, cash is king in many, many businesses, okay? So the longer you can hold on to the premium in one of your subsidiaries rather than off your balance sheet, the better. So people use that as a way to manage their cash. I already mentioned that you establish this captive, ideally in Labuan, but always, almost certainly always, in a low regulatory environment, an efficient, low cost, but also tax efficient environment. Because hopefully, over time, this insurance subsidiary is going to be profitable. It's going to take in more premium than it pays out in claims. If you put that insurance subsidiary onshore, a high tax location, you're going to pay tax on that. So if you have a chance, an opportunity to domicile it in Labuan, where the tax rate is either 3% or 20,000 ringgit at your option, that sounds pretty attractive, yes? The problem is that if you do it onshore in a high-cost jurisdiction, then ultimately you're eating away at the net profit of that entity, all right? I've already talked about specialist risks, and I don't think I'll because we've limited on time. Okay. How would you go about forming a captive? The first thing I say when people talk to me about whether or not they should have a captive is how much premium how much insurance do you currently buy? Do you pay away a lot of premium every year to the commercial market for your risks? And how much do you get back in the form of claims over time? How much is your business profitable to the insurers and the reinsurers? If so, and it's of a sufficient size, you might go through what we call a captive feasibility study to look at the costs and the benefits of establishing a captive. You'd look at, as I said, your losses over time relative to your premium. And if you and your advisors subsequently determined that it made some economic sense to go down this road, you then have to apply to your regulator. Once again, this is a regulated financial service, okay? So you've got to apply to the regulator, you've got to get a license for this captive. You've got to register the company, clearly. In Labuan, that's done through your trust company. The Labuan, I can say this because I'm a consumer of the services of the Labuan ecosystem. The Labuan ecosystem has a fantastic capability through its trust companies and managers to manage businesses for you. So you'd appoint this trust company to register your company. You'd appoint your insurance manager to manage the captive, and we'd establish a board and appoint a company secretary for that business. We get that license, and we start writing business. That's a pretty well-trodden roadmap. The managers, Etika Offshore, Brighton, LIMS, they can all advise you on how to do this. Lots of people have done it. This is what I was beginning to paint a picture about before, but it just shows you where the captive insurance company, and I wonder if I can get this to work. Yes, okay. Where the captive insurance company fits in the whole picture here. I mean, this is here on the left, this is the position that I was describing to you earlier. You as the insured buy insurance from an insurance company, Etika Insurance, here in Malaysia. But Etika, given their exposure to potential catastrophes and for other reasons, will manage the risks in its insurance business by buying reinsurance from a reinsurance company that in turn, on occasions, will buy retrocession from retrocessionaires. And then these on the right here show you the intermediaries that typically advise and help negotiate those contracts in return for a commission. If we have a captive, it typically fits in here. A captive in Labuan would usually assume reinsurance from a domestic insurance company. The reason for that is, as the insured, when you buy insurance, onshore Malaysia, but also in most countries around the world, you're required to buy insurance from an onshore, registered, domiciled, and regulated insurance company. All right? It's what we call admitted insurance. All right? So you would go to a local insurance company in the jurisdiction that your assets or your liabilities are situated, and you'd buy that insurance policy, but then you would insist that that insurance company buys reinsurance from your captive based in Labuan. All right? Okay? And then that captive in turn manages the risks within its business by buying reinsurance from those same reinsurers that I was talking about earlier. And that ability to access and negotiate directly with the major reinsurers around the world is, I think, where the biggest single benefit arises through the captive industry. All right? But you've got the same intermediaries advising on the process and what kind of risks and how you would structure the reinsurance. Once again, probably too detailed for here. You've got the flow of cash into an insurer, and this is the same for a reinsurer and a captive. Essentially, there is capital, and that capital, together with the premium flow into the insurers, is invested and generates investment income for the insurer. The insurer, as I've already said, buys reinsurance. So it's premium it pays away. And it pays out claims, clearly, to its policyholders and incurs operating expenses through the management of its business. Okay? And the difference between the two is the profit, and that's paid out as dividends to the shareholders and or held to increase the capital and surplus of the insurance company to allow it to bear further risk in future. And this is true of any insurance entity, be it an insurer, a reinsurer, or a captive. Okay? These are some of the practical issues that you would encounter if you had a captive, and to be frank, probably a bit too sophisticated in terms of issues today. So I think we'll leave that. But this is important. It's something I've touched on already. How would you decide where to establish your captive? What domicile would you choose? Clearly, we'd like you to choose Labuan. But what you need is, as I've already said, a tax-efficient location, a cost-efficient location. You don't want to waste away all of the profits of this insurance activity and reinsurance activity through just excessive cost and or tax. So those are clearly two key determinants. You need a regulatory environment which is light touch, but still adequate and respected around the world. Because almost by definition, you're trading cross-border, you're insuring or reinsuring the assets of your parents, typically all around the world. So you're going to be doing business in, not just in Malaysia, but in all around Asia and wherever your parent has assets and liabilities. You're going to be doing business in other jurisdictions. So you need your jurisdiction to be credible as a host. But you don't want excessive regulation or the same level of regulation that, for instance, is necessary onshore Malaysia to protect the man in the street when he buys car insurance. Because, as I said, this entity is just taking the risks of your own risks, okay? So you don't need that. You're not insuring third parties, and in particular, you're not insuring the general public. When you're insuring the general public, you need really very strong regulation in all aspects of financial services, including insurance. But this is not that. This is wholesale, it's specialist, and therefore you want a good balance between light touch but credible on a global stage. All right? So, substance is increasingly something we're talking about in our business. You may be aware that the OECD is discussing with governments around the world how companies like Google, Apple have succeeded in avoiding paying tax by being paying very close attention to how they manage their global operations. Apple, I think, notoriously has something like $500 billion of cash that it cannot repatriate to the US. Something like that number, okay? So, what has happened is that the key governments, through the OECD, have got together and said, look, we need to establish how companies are avoiding paying tax and try and create as level a playing field as possible around the world. And one of the key components to that is this concept of substance. And what substance says, I mean, in accounting terms, and I'm not going to get into this in great detail, but just to give you a flavor of it, what it basically says is, in order to demonstrate that you're doing business somewhere, you have to be able to demonstrate real substance of activity there. You can't just book something in Panama and forget it, and then just argue that you're earning hundreds of millions of dollars there, there's no tax payable, it's all there. Okay. Increasingly, Apple and others will have to demonstrate where they recognize profit, there is real activity being undertaken by that entity. And that is just as applicable to captives. And in fact, captives have been singled out as potential vehicles to avoid paying tax. Okay? So, it is essential today and increasingly in future that domiciles like Labuan help companies like mine in Labuan demonstrate real substance of activity in Labuan so that then I only have to pay Labuan tax. And the same is true for a captive. You have a captive in Labuan, you have to be able to show your host government of the parent that I'm really managing an insurance activity in Labuan, okay? So I'm sorry to get a bit technical on you, but I think this is a real emerging issue in insurance and reinsurance, and in particular captive work, okay? That domiciles have to help their ecosystem demonstrate this real substance, all right? I hope that's clear. We've already talked about sort of cost efficiency generally, but what do you need to set up a captive in Labuan? You only need 300,000 ringgit, which is the capital, the sort of the equity that you, as the owner of that captive. You have some initial processing fees, and then an annual license fee that you have to pay to the regulator. We talked about the tax. You may have sort of wondered why there is this option to elect to pay onshore tax here in Malaysia. As I think Daniel said earlier, as an entity based in Labuan, you have access to most of Malaysia's double taxation agreements, okay? There are a few exclusions of Labuan, and in that particular circumstance, if your host country, if your parent is based in one of those countries that singles Labuan out of the double taxation agreements, one way of dealing with that is to opt to be taxed onshore Malaysia. And then you can get reaccessible. Bit of a technical issue, but the point, I think, that the general point to understand is that Labuan creates the flexibility you need in order to maximize the efficiency in terms of cost and tax of this activity, all right? Okay. Now, as I said, we've gone from simple addition and subtraction to differentiation and integration in about 20 minutes. I hope I've left you with enough of a picture, but we're going to have a panel now, I think, to ask any questions. Thank you very much for your time and your interest.